Hello everyone, welcome to the part 2 theory base of accounting. So here we'll be discussing the theoretical aspects of accounting. The theory base of accounting consists of principles, concepts, rules, guidelines developed to bring the uniformity and consistency to the process of accounting. So theory base means the principles, concepts, rules and standards guidelines developed to bring uniformity and consistency in the accounting practice. Along with these concepts, principles, rules, and guidelines, there are some standards issued by the ICAI, Institute of Chartered Accountants of India, which is the governing body of accounting profession in India. And they are making time to time guidelines and rectification in the practice of accounting. So GAAP is termed as generally accepted accounting principles. In order to ensure uniformity in accounting procedures and methods, certain accounting principles have been accepted by all the accounts all over the world. So there are some uniformly accepted methods and principles. The rules and guidelines used in preparing accounting reports are termed as GAPs, generally accepted accounting principles. So all the procedures, methods and principles, so in order to make the uniform accounting results can be termed as GAPs. So every countries will be having their own GAPs. We Indians having Indian GAPs, US GAAP is there, American GAAP is there. I mean, for every country is having their own gaps. So here we'll be discussing about the accounting concept. The accounting concepts are referred to as the fundamental ideas or basic assumption underlying the theory and practice of financial accounting which are developed by the accounting profession. So the basic ideology or concepts for the accounting practice is termed as accounting concept. For the practical point of view, these concepts are known as principles, conventions, modifying principles, assumption, etc. So all these are the basic accounting concepts. So let's discuss the basic accounting concepts one by one. The first one, business entity concept. This concept assumes that the entity of the business is separate from its owner, the business having its own existence apart from its owner. The business and the owner of this business are the different persons. The owner is the natural person and the business is artificial person. The business having its own existence. That's the one of the fundamental accounting concept. And the next is money measurement concept. According to this concept, transactions that can be measured in terms of money only are recorded in the books of accounts. The non-monetary transactions are ignored. We can't record this non-monetary transaction. Only those transactions which are capable of measuring in terms of money are recorded in accounting practice. Then going concern concept. This assumes that the business will last for long time periods. None of the business are meant for shorter periods. Every business will last for longer time period. That's one of the basic assumption. Then periodicity concept or accounting period concept. The period of interval for which accounts are prepared to know the profit or loss and what exactly the financial position of the business is called the accounting period. So this is the basically is a 12 months period starting from April 1st to 31st March, and all the financial statements are prepared for this particular period. Then cost concept. This concept assumes that all the assets are to be recorded at the total amount paid to acquire, which means the acquisition cost and the all other necessary cost or subsequent cost for those assets. So the cost of assets should be included Why is acquisition cost or purchase cost and installation cost and all other necessary costs to make that asset in usable condition. Then dual aspect principle. This is the basic principle of accounting. According to this concept, every transaction is having two aspects, debit and credit. They are receiving aspect and giving aspect. One will be receiving and one will be giving. I mean, one will be debiting and one will be crediting aspect. So every aspect or this dual aspect should be recorded for every transaction. So we can't see a transaction without this dual aspect. Then revenue recognition. Revenue is the amount which the business earns through sale of goods or providing a service. So the principle says that revenue is earned or recognized at the point of sale when the title of good passes from the seller to the buyer. So at that time itself the revenue should be recorded. So which means that none of the revenues are recorded at the time of cash payment. Cash paid or not paid, that doesn't matter. When the title of goods passes from the seller to the buyer, we have to record the revenue. Then matching concept. It says that expense incurred in accounting period should be matched with the revenues during that period. It means all the expenses incurred in a particular period to earn revenues of that period should be recorded in that period itself. Then full disclosure concept. So the accounting statement must be prepared honestly and should contain all the material informations and their accompanying footnotes regarding the financial position of the business. The users are making their decision by looking into the financial statements. So everything regarding that financial performance should be fully disclosed in that financial statement. That's the full disclosure concept. Then consistency concept. Consistency means continuity or steadiness of different policies or practices. So the accounting information provided by the financial statement would be useful only when it allows comparison over a period of time. So this comparison is possible only when they're having consistent policies and practices in their accounting. So all the policies, practices, technique, everything should be consistent year to year. It should not be changed from year to year. Then conservatism concept or prudence concept, also known as prudence. It says that anticipated profit are not to be considered but only possible losses while recording business transaction. So anticipation of profit is not allowed, but possibility of losses is to be recorded. So an expected profit should not be recorded, but an expected loss should be recorded. It's a kind of playing safe. Then materiality concept. It implies that disclosing of items in financial statements in accordance with the relative importance they have. So only relevant and important items are to be recorded in the financial statement. Unimportant items are not need to be disclosed in the financial statement. Then objectivity. The principle says that the accounting data provided in the books of accounts should be verifiable and dependable. So by analyzing the financial data, one can make his own decision in that company. So the figures shown in the financial statement should have supportive evidence such as bills, vouchers, etc. So everything should be verifiable, or all the transaction recorded in the accounting practice should be verifiable and should have legal compliances. Then accounting standards. Accounting standards are the written statements of uniform accounting rules and guidelines or practice for preparing uniform financial statements. It is important that everyone should follow the accounting practice in an uniform way. Then only we can compare the various results of different organizations. So the objectives of accounting standards to bring uniformity in different accounting practices. Bring uniformity is the main objectives of accounting standards. Then, accounting standards in India are formulated and governed by ASB, Accounting Standard Board, which is set up by ICAI in the year 1977. So it's the one of the subsidiary board of ICAI, and which is came into existence on 1977. Then IFRS, International Financial Reporting Standards. As we mentioned earlier, accounting standards are needed in order to make uniform accounting practices. But we need these uniform policies and guidelines in global levels. So IFRS are globally accepted accounting standards developed by the International Accounting Standard Board, that is IASB. So it is the international accounting standard to make the global accounting practice in a uniform basis. It is a set of accounting standards for reporting different types of business transactions and events in financial statements. The objective is to facilitate international comparison for true and fair value of business enterprise. So if we are following these IFRS standards, all the financial statements all over the world will be verifiable and accurate, and we can compare it very easily. The need of IFRS. Mainly there are three important need of IFRS. First one, IFRS help to prevent material manipulation or errors in financial statements. So it enhances the credibility of financial statements. Then it brings uniformity and comparability of accounting information on global basis. In the worldwide, it brings uniformity and comparability for the accounting information. Then it facilitates global investment. It encourages global investment or worldwide transaction by enhanced trust and reliability. These are the need for IFRS. Then GST, Goods and Service Tax. All of you know about it. GST is a destination-based tax on consumption of goods and services. It's a tax levied on the consumption of goods and service. It is proposed to be levied at all stages from manufacturer point to the final consumption, with credit of tax paid at previous stages available as set-off. That means only value addition will be taxed. So each and every stage the value addition will be taxed, and the burden of tax is borne by the final consumer. So GST is a destination based tax system followed in India. So there are different components of GST. First one, CGST, means Central Goods Service Tax. CGST is collected and will constitute the revenues of the central government. So it is the tax to the central government, and the present central tax like central excess duty, additional excess duty, special duty, etc. will be subsumed under CGST. So it is the portion of tax to the central government, and SGST is the state goods and service tax, is the portion of tax to the state government. So it's the revenue of state government. Then IGST. IGST refers to the integrated goods and service tax. So it is collected by the central government when there is transfer of goods and services from one state to another. The IGST will be there, and it will be allocated or divided between central and state government. So these are the three components of GST. And this is the end of our part 2. Thank you.